Uh, uh, Good evening to everyone in India, and good morning to the investors who joined us from US. I hope we've already gone through the investor update, which is already been shared. India's GDP growth for the fiscal year 2019-20 was revised down by Central Statistics Office (CSO) to 7% from 7.2 earlier. Data from 3 quarters indicate GDP growth has been broad-based. Industrial growth accelerated to 7.9, making up for the deceleration in services. Meanwhile, agriculture growth was robust at 4%. Even with the downward revision to 7%, India remains the fastest-growing large economy in the world. Importantly, even as growth has moderated slightly, in the second half of the year, several indicators point towards stable macroeconomic environment. Inflation based on the CPI has been largely benign throughout the fiscal. There was an improvement in current account deficit. Currency has been stable. IFP numbers have shown some green shoots during the year. In April, Monetary Policy Committee of RBI announced its second consecutive rate cut, bringing total reduction in policy rate to 50 basis points in this ongoing rate easing cycle. The recent policy rate cuts by RBI, bringing down the repo rate to 6%, are expected to positively impact all sectors by reviving the demand. However, it is likely that automobile, consumer durables, and NBFC sector will be key beneficiary once the impact of the rate cut is transmitted through banking system. While two-wheeler and passenger vehicle demand may see uptick over the next couple of months, the impact of commercial vehicle sales will certainly be visible as the investment cycle improves. Starting January 2019, vehicle manufacturers hiked prices by 2 to 5%, owing to increased raw material cost and implementation of new safety features. Demand conditions were generally soft, and there was uncertainty prevailing ahead of ongoing general election. This led to subdued sentiments towards second half of financial year 2019. Despite these issues, as well as widespread liquidity crunch, commercial vehicle industry has posted double-digit growth for the full year for 2019. Having said that, CV volumes would have been better for the sustained slowdown, in the real estate sector, since the bulk movements of cement, steel, and sand, etc., were absent. The demand for the heavy vehicles came down, and also the demand for the finished goods like AC, TV, refrigerators. Over the past 3-4 months, there has been dip in heavy vehicle sales because of that. Recent regulation for commercial vehicle have increased the axle load for the trucks, and that has helped the individual transporters to improve his profitability. There has been 15 to 20% additional capacity that has helped them to manage the increase in fuel prices, and that also helped us in improving the asset quality. Even as the demand for the new vehicle was muted, used vehicle displayed healthy demand. The lending for used second-hand vehicle is largely dependent on the reach that we create, and we are able to create more reach by adding more number of branches in this financial year. We have added 332 new branches in the this financial year, and most of them beyond Tier 1 cities in the semi-urban and the rural market. The other major factor for the industry has been liquidity. Following the development in October-November around the housing finance companies, we can safely say that situation has completely normalized now. Currently, we are witnessing stable liquidity. HDFC has proactively explored alternative routes of funding from the start of financial year 19 and have consistently raised adequate funds. Over the course of financial 19, we have raised 5,000 crores through public issue of NCD, exhausted USD 750 million limit on ECB. Recently, we launched $2 billion global medium-term note program, of which first tranche of $500 million of senior secured notes were successfully issued and allotted. RBI has been extensively supporting liquidity, which has helped to partly mitigate the tightening of yields in the second half of the year. Our securitization program is going well. However, the cost of borrowing has gone up. Our pricing power in used CV is better, and increases can be easily passed on to the customer. Stronger growth in rural market again supports a higher yield, and we should be able to manage even a further increase in the coming year comfortably. We are getting more into rural market, and therefore the spread would remain healthy for us. We had reduced LTV value for lending in mid of last year, and we are continuing to pursue conservative lending. And as we see good progress this financial year, we should be able to release the same and lend aggressively. Coming to the results for the quarter, AUM stood at 1 crore 4 lakh 482 against 1 crore 3 lakh 817. The net interest income increased by 2.76 to 1905 crores from 1854 crores in the corresponding quarter last year. The net interest margin stood at 7.22 this quarter compared to 7.61 for the same quarter last year. Q-on-Q increase was just 22 BPS from 7.22 against 7.44. That decreased by 22.43 year-on-year to 746 crores against 961 crores in Qtr4 FY19 due to adoption of Ind AS, and as per IGAP, it stood at 144 crores last year. The profit for quarter includes 109 crores of tax adjustment for the earlier years. The earning per share are at 32.88 against 42.39 in the previous year. Now, coming to the result of full year, AUM increased by 8.54% to 1,04,482 against 96,260. The net interest income increased by 15.07% to rupees 7,807 against 6,785 crores. The net interest margin declined by 11 BPS to 7.41 from 7.52. PAT for the full year stood at 2,564 crores against 2,460 crores for the financial year 2017-18. As per the IGAP, it stood at 1,568 crores. The gross stage 3 assets stood at 8.37 against 9.39 year-on-year, improvement of 100 basis point. And the net stage 3 assets stood at 5.49 for the Q4 in this financial year against 6.19 year-on-year and 5.86 Q-on-Q. We also have brought down the overall credit cost to from 2.25 to 1.92 in the last quarter, and for the full financial year to 2.16%. Our total number of branches stood at 1545 and employees at 26,630. HDFC has proposed dividend of 7 per share. This in addition to interim dividend of 5 per share. This works out to 120% per share against the total dividend of 110 in the previous year. Looking forward, there is a huge growth potential, particularly in the semi-urban rural market. In the census statistics from 2001 to 11, the number of towns increased from 1,500 to 7,000. That means there's more and more small towns and hubs are coming into the commercial activity, and we should be able to reach out to all these centers and improve our reach and improve our lending and business. The result of general election are just about 2 weeks away. With the conclusion of the process and settling in the new government, we can expect activity to resume unhindered once more. Also, the initial prediction of good monsoon is really very good for us, especially when we are rural focused and having a good rural reach. We expect with good monsoon and good demand from the rural market, consumption would increase, and that will create better demand for the credit. Additionally, the BS6 implementation will also help us because there would be increase in price by 15 to 20%, and that should help us in expecting a better demand. The demand should come from both heavy vehicle and the LCVs. And used vehicle also would benefit because there will be a repricing, or the resale prices of the vehicle would get repriced, and we will have a better asset coverage. And not only that, ticket size per vehicle would go up, and that should help us to grow our AUM. We expect around 12 to 15% growth by September and 18 to 20% for the full financial year. That brings me end of opening remarks. I have with me Sundar, Parag and Sanjay to answer specific questions. I would now like to request moderator to open the floor for any questions.
Sure, thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. So I have a question regarding our urban AUM growth. If we come to slide 7 of the presentation, we have added up 195 branches, urban branches during the year, but the urban AUM growth has been almost flattish at around 2% year-on-year growth. So probably even on the existing branches, the business momentum seems to have weakened. If you could share some color on what's happening in urban geographies that is leading to a weaker growth.
See, our focus has been last 5 years on the semi-urban and the rural market, because we feel that the growth opportunity in this market is much larger than the urban. Urban areas are well covered by most of the other institutions and banks. So where there is credit shortage, we wanted to focus there so that we can have a niche presence. And the used vehicle demand is also much higher in semi-urban and rural market, not the same in the urban market. So our growth will be more towards semi-urban and rural market in going forward also.
Right.
I'm sorry to interrupt you, Mr. Mandora, but there's a lot of disturbance on your line, so I'm static.
Hello?
Yes, Mr. Mandora, you may go right now.
Sorry, so, sir, in urban locations, we have added around 195 branches. So if the focus is not on urban, so what was the rationale in adding these branches?
No, these are the satellite branches which we have added to the urban centers. We have split the existing urban branches and created a satellite branch which is bordering the semi-urban areas.
Okay, got it. And if you would share the disbursement numbers for the 4Q FY19 in terms of new pre-owned and others?
Disbursements, the new vehicle is 812 crores and used is 11,024. Total is 11,958.
968.
Increase of 25%.
Okay. And so, in terms of the sourcing mix, like how is it split between say private financials and field officers, and how is that changing in the past 1 year?
See, private financial, there has not been much growth, but we expect now a better growth because many of these private financiers who are not able to leverage and raise resources, and they are wanting to become our franchise. So I believe next couple of years we should be able to add more private franchise into our network, and we should be able to build better reach.
Right, but out of the new disbursements, what percentage will be contributed by private financials right now?
Right now, not much, not significant enough.
Okay. And so, what is the guidance with respect to NIMs and disbursements for next year?
Next year, we expect the AUM growth of 18 to 20% because we are factoring in the higher demand because of BS4 to BS6.
And sir, on NIMs? Net interest margin?
Net interest margins would remain at present level at around 7.2 level.
Sure, sir. Thanks a lot.
Thank you. Next question is from the line of Qtr4 from IIFL. Please go ahead.
Hello. Good evening. Hello.
Yeah.
Yes, sir. Good evening. This is Abhishek from IIFL. So, sir, my question is, one, what is your incremental cost of funds for the quarter? And the second thing is, have you changed any PD, LGD assumptions in this quarter versus the last quarter as far as the ECL provisioning goes?
For the PD and LGD, for the current quarter, we have assumed 12-month PD to be 6.07 as against 5.85 in the previous quarter, December quarter. And coming to the lifetime PD, in March we have considered 17.24% as against 17.09 in the December quarter. And LGD, we have maintained 32.46 as against 34.78 in the previous December quarter. And as far as the
borrowing, in fact, there were two major sources what we tapped. One was the dollar bond market, and other was securitization. The securitization, because it's priority sector, the rates were around 8.5 to 8.75. But the dollar bond, what we did for 400 million, that was fully hedge cost to us was slightly higher, close to around 10%. So this was one-off transactions, so we can't take the average if we talk about incremental. If we exclude this, then I think we are at around 9.5.
So domestically, you would be borrowing at 9.5 incrementally for the rupee fund.
Correct. Around 9.5, yes.
Okay. And so in terms of your OPEX, you have added a number of branches, and obviously some of them are satellite branches also. But your employee strength remains almost as it is at 26,000 for the last 2-3 quarters. So is it that going forward you will be adding more employees to man these branches, or is it that it's operating, it's really better productivity and now you don't need that many people per branch?
See, we have added for the last financial year around 3,000 people. So we did hire a little more aggressively in the first half of the year, and therefore it was sufficient for us for the full financial year. So this year also we will be adding another 3,000 people. So we do definitely need people because our segment of the customer need more reach and better understanding of the business also is required for us. Each individual need to be treated as a businessman. So therefore our reliance on people would be there. However, we are also adding technology to improve the efficiency and productivity of each of the field officers. Today we can do anything and everything on the mobile at the field, and our field officers need not really come to the office at all. But still, the human touch and reach is important to understand the business and also for better collection efficiency.
Okay. So, sir, just sort of, on this, if I just look at some metric like, employee per branch or something, it's still gone down to 17 from 20, despite your 3,000 people addition during the year. So would you think this kind of, at the current level, of 26, 27,000 people, is this enough for 50 branches? Or how many branches, let's say, are you adding next year or planning to add next year?
We will be adding 250 branches and we'll be adding 3,000 people. So approximately 10 per new branch we need to have, and that is including at back office, front office, field, etc. But as you rightly said, there will be definitely productivity gain over the period, and that productivity gain will help us to reduce number of staff per branch.
Okay. Okay. And sir, just because you said that your NIM will remain broadly at the current levels, so does this also mean that the elevated, amount of investments and cash that you are carrying today, that will continue through FY20? Or are you looking to bring that down?
No, we will be carrying additional cash. It is not just to have that precaution, but we also look at good scope to growth in the second half of the year. So we would like to keep the cash, and that will continue for the next financial year.
Okay, so roughly 4,000 odd crores plus minus something will remain in cash, and similar amount of investments will also be there on the book.
Little more than that. Correct, no, Parag? Yeah, the little more than that would remain in the balance sheet.
Okay, sir. Thanks so much. Thanks and best of luck.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, so 3 questions. Firstly, in terms of the interest income, so there is a sequential decline in the absolute amount. So just wanted to get the sense, is it on account of lower lending rates or lower yields and shift in the portfolio mix, or there is some component of the off-balance sheet item which is leading to this?
Yes, Sundar would answer.
See, there are 2-3 factors affecting this. One is that we were also carrying higher investments and cash bank balance that has contributed to a lower interest yield in the current quarter, and disbursements were primarily driven in the current quarter in the fag end of the year, March basically, and hence the average balances during the quarter was comparatively lower compared to the December quarter. So these factors contributed to the lower income compared to the December quarter.
Okay. So maybe in terms of yields, would we consider it to be more of a normalized level in terms of a Q4, because this is despite the stage 3 assets also coming off?
Yeah, yields have been fairly stable in the current quarter also.
Okay. And secondly, in terms of when we did some ground checks, in fact, some of the customers, have they started asking for a relatively higher tenor loans, or maybe in terms of the extension of the existing tenor? Is it a more pan-India phenomenon, or it was just there in some of the pockets?
We have not really experienced that, because normally when we lend itself, we do take consultation with customer and fix the tenor. So in between, we don't really encourage any increase in the repayment period. And a new loan, a customer asking for higher tenor doesn't happen with us, because what we do is we reduce the LTV and reduce the loan amount to match the installment, so that because of increased lending rate, the interest amount going up, and because of that tenor going up doesn't happen with us.
Okay, so we try to offset it with a relatively lower LTV.
Yes.
Okay. And lastly, in terms of the loan loss provisions, if we look at Q4 of last year, in fact, there the provisions under the Ind AS are significantly lower, hardly like 97 odd crores. So what exactly, and when we look at last 4 quarters, in fact, on an average, it's been around about 600 odd crores. So was there any change in the assumption in the Q4 of last year which is leading to this under Ind AS?
See, there were 2 factors that contributed to a lower provisions and write-off in Q4 2018. One was around 250 basis points came down in the LGD, and there was compared to the December 2017 quarter. And similarly, the PD levels also were again revised in the March 2018 quarter. This has contributed to a lower provisioning compared to December 2017. And the other factor was the write-offs in Q4 2018 was comparatively lower. So these 2 factors put together resulted in a lower provisions and write-off of 97 crores. And we we generally revisit the LGD and PD levels on a yearly basis in the month of the quarter of March every year. So going forward also, there may be some deviations in the March number. So it may be...
Okay, so if we just look at... So what would be the LGD of Q4 of last year and this year?
One second. The LGD of March 2018 was 33.81 and the LGD currently is 32.46.
Okay. So in fact, still year on year it is off.
Yeah.
Okay. And lastly, in terms of the write-off for this particular quarter?
The write-off for the current quarter is 806 crores and we got a write-back in the provision of 267 crores and net comes to 540 crores.
Okay. So 800 crores is the write-off during the quarter?
Correct.
And for full year?
And for the full year, the write-offs were 2,347 crores and provision incrementally was 110 crores.
Okay, so this is the reason for the lower tax rate as well.
Correct.
Okay, yeah, thanks a lot.
Thank you. The next question is from the line of Subhranshu Mishra from BOB Capital Markets. Please go ahead.
Hi, sir. Thank you for the opportunity. I wanted to understand your acquisition strategy customer acquisition strategy in the rural and the semi-urban areas and the cost of acquisition in the semi-urban areas versus the urban areas. So what is the difference quantitatively? That's my first question, sir.
See, basically, there is not much change in the strategy on customer acquisition. We normally build a customer network and through customer network and reference, we keep adding or lending to or identifying the new customers. Because when there is a buying and selling transaction, either the buyer or seller, one of them would be known to us or previous borrower. And that helps us in lending. We also take existing customer as a guarantor, and that is maybe a hindrance to faster growth, but it helps us in future collection and putting a peer pressure. So our acquisition is basically by knowing the customer, understanding the customer, be part of the community, and know each and every customer.
Right. So, and what is the difference in the cost of acquisition in rural and semi-urban areas versus the urban areas, sir? For file size, what would be the difference? File, what would be expensive?
It is mainly because of lesser file size, smaller ticket. The cost of acquisition as a percentage will be a little higher for used for rural market. But that we compensate by charging lending at higher rate. So we normally lend around 200 basis points more at the rural market than the urban market for similar product.
Right. Just wanted, can you quantify the cost per file in a rural area versus an urban area?
We can't quantify that. because we have not done that exercise.
Right.
Yeah.
Sure, sir. And two data keeping questions, sir. One is, what would be your tonnage-wise split of your portfolio? And second, how do we look at the credit cost in FY20 going forward?
Tonnage-wise, if you look at, we have a given breakup of heavy LCVs. That is the major segments we have done. We can't go tonnage-wise because from 1 ton to 50 ton, we have so many segments.
Right. Sure, sir. And credit cost guidance for FY20, sir?
Credit cost is at around 2% now, and it should remain at that level.
Sure, sir. Thank you so much for your time, sir. Best of luck.
Thank you. The next question is from the line of Adarsh P. from Nomura. Please go ahead.
Yeah, sir. First question is, you said the incremental cost of funds are 9.5. What was the cost of funds on book in fourth quarter? What was the on the stock? What's the cost of funds?
Parag, you'll be able to answer.
In the meantime,
it will be around 9%.
So incrementally you're borrowing like 50 bp higher than the stock, right? Okay. And what about the incremental yields on disbursement vis-a-vis the incremental yield on the book? If you can just give that as well.
No, the incremental increase is around 50 basis point, almost same. We do at almost immediately on whatever the increase is there in borrowing cost, we pass it on to the customer. But only thing is, since our lending has been a little slow and it picked up only in the end of the quarter, it may not get reflected in your overall NIMs.
And, so the other question is, you kind of gave a very strong guidance, specifically if you consider the environment today in terms of how OEM growth is. Just wanted to understand what's that based on, because OEM numbers look pretty weak. And if you target like 15-20% growth, what specifically happened in this quarter then? You had similar problems with OEM growth, and your AUMs have not grown in this quarter. So why should that pick up, barring an event of, say, the PS4 to 6 transition, which may happen in the second half of next year?
See, there are multiple factors. The real estate is almost come to a standstill, and bulk materials are not at all moving, and that has slowed down the heavy vehicle movement. And the existing heavy vehicle has been used for the other business activities. That means once the real estate picks up, there will be additional demand. And also, post-election, many of these coal-related transportation also, many of the bidding has been stopped because of the election. And post-election, I believe, most of this coal-related movement also will start moving. So that should again help us. And infrastructure spending by the government has come to virtually standstill because of in November, the 4 states or 5 states went on election. Again, now there is a election was announced. All these things has slowed down the demand for the heavy vehicle. But if you look at the LCVs have been growing at double digit. Throughout the second half of the year, when the heavy vehicle demand came down, LCV was growing at 10%. That means LCV has already crossed 5 lakh unit in a year. So that means there is a good demand from the rural market. And I believe if the demand from the rural market further improves because of good monsoon. Last year, monsoon was predicted normal, but it turned out to be not below normal at 91% against 97% prediction. So in spite of that, the demand has been, the LCV demand has been good. So I feel the good monsoon, the LCV demand would continue to remain strong. The tractor demand will grow up. Then automatically the demand for the heavy vehicle also will start picking up. BS4 and BS6 movement would be a significant impact in India because the price increase is likely to be 15 to 20%. Once the manufacturers start giving guidance on the price increase, there would be a significant pre-buying in the month of starting from August to March. So because of that, I feel there will be a significant demand for the commercial vehicle, both in new and used. Even though we are focused more on used, the new vehicle demand will slowly percolate down and create a bigger demand. So these are all the assumptions on which we are going. And plus, with the new government coming in, they will come with a lot of ideas, plan, and push the economy. They will not be facing the election, so definitely they will be bold enough to initiate a lot of economic activity to boost the economy.
Sir, just a question here. When I see your AUM growth post-September, right, from 2Q to 4Q is almost flat. When I compare, so sometime, for most NBFCs, it's a problem on the funding side. For you, the assumption would have been, should not be. And then similar gets reflected in your borrowing mix, right? You've been able to borrow from capital markets through NCDs. The point I'm just trying to understand is, was any of the slowdown in the last 6 months for you also a function of funding constraint at some point of time? It doesn't seem so, but I just wanted to check if that's the case, because what I'm seeing for most other financiers, especially banks, is that their CV books have actually grown. So it's quite surprising that if you didn't have funding constraints, your AUMs have not grown for the last 6 months.
See, we did slow down in the month of October. Then we brought new LTV norms where we decreased the funding. Moment you ask more margin, more investment from the customer, automatically the demand would slow down. So this was basically to understand the market sentiments and then to move forward. We did it, but we continued with that for the last 6 months. And even today, we are continuing with the lower LTV kind of lending norms. We have not relaxed that because we wanted to wait till the election and then, depending upon the market sentiments or the market activities, to relax. That's the reason we grew slow. But first half of the last year, we grew more than 20%. And for us, definitely there was no constraint, but we decided to carry more cash because we are not sure how long the uncertainty would continue.
Understood. No, sir, that's useful. Thanks a lot. Yeah.
Thank you. Before we go ahead, I'd just like to inform the management there's a lot of disturbance on the line, a little background noise.
We don't experience here. In between it was there, but now it's not there.
All right. The next question is from the line of Pranay Rajani from B&K Securities. Please go ahead.
Yeah. Hi, sir. Just a few data keeping points. If you could just repeat the disbursement number once again, it would be great.
See, if you look at the disbursement in the new vehicle for the quarter was 812 crores.
I'm sorry to interrupt you, but we can't really hear you.
Yeah.
Just give me a moment. Let me...
Yeah, now it's clear?
Yeah.
Yeah, the disbursement for the new vehicle was 812 crores for the quarter.
Yeah.
The used vehicle was 11,025 crores.
11,025 crores.
And the others were 122 crores.
122 crores.
So the total was 11,958 crores.
Okay.
An increase of 25% over the previous quarter.
Okay. All right, sir. Apart from this, the incremental cost of yields during the quarter stood at 9.25%. Am I correct?
9.5.
9.5. And what would be the incremental yields during the quarter?
We increased by 50 basis points, almost same.
So if you could provide me a number, that would be great. Approx number.
Sanjay will give you the number.
All right, sir. And on the credit cost, where do you see it going forward in next year, and like what are your plans on the same for credit cost?
The credit cost has already come to 2.16 for the full year in the last financial year. So we are targeting 2% in the next financial year.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Karthik Jalappa from Buena Vista Fund Management. Please go ahead.
Yeah, thank you for the opportunity, sir. My first question is, earlier in your AUM growth guidance, you had alluded to around 10 to 12% for the first half of the year. How much of that would be coming from, let's say, a relaxation or increase in your LTV versus organic growth?
We don't really plan to relax till the election is over, and maybe once the election is over, depending upon the market condition, then we would be relaxing. Mostly, if the monsoon indication is good, maybe month of July, we would like to relax. Till then, we would like to have a controlled lending.
Okay, got it. And my second question is, if we look at our employee expenses for the quarter, which is like about 204 crore, this was almost flat year on year, and it has actually dropped about 7 to 8% quarter on quarter relative to Q3. Given that we have continued to hire some employees even during the quarter and throughout the year, why is the employee expenses not growing?
If you see in the last 6 months, the business itself, disbursements were flat and the AUM growth has been flat, and most of the component of the employee remuneration as far as the field staff is concerned is more driven by the incentives. So since the business itself was down, consequently the incentive also was paid lower. That was the reason.
So can we say that the incentives that you have, there is a higher weightage for disbursement as opposed to, let's say, collections and asset quality, which is why the expenses did not grow? Because the asset quality, I think, held up pretty well, and the collection must have also been pretty decent. It's just that the disbursements were weak.
The weightage is given for all the factors, be it disbursement, collections, and then the quality, asset quality, and so it is interlinked. So I would not say that more weightage is given for disbursement.
Okay, perfect. And sir, if I heard you right earlier, your NIM guidance for the full year is similar to our exit quarter NIM, which is about 7.2. Am I right?
Yes, you're right.
Okay, got it. Thank you, sir. Thank you very much, and wish you all the best.
Thank you. The next question is from the line of Saurav Bole from Trivantage Capital. Please go ahead.
Yeah, sir, thank you very much for the opportunity. I just had two questions. One is, in this particular quarter, you've added about 200 branches, as in you already spoke about how you have split some of your urban branches. Why doesn't this reflect in your OPEX? Because if I see sequentially, the OPEX is kind of down. So why shouldn't it reflect there?
See, many of these branches have been opened to the back end of the year, planning for the next financial year, so it will come subsequently.
Okay. And I think you already spoke about the PD and LGDs which you revise or revisit, I think in the month of March. So the PDs and LGDs that you've assumed for your current stock of stage 1, 2, and 3, those are based on this particular year, or they are based on revised figures?
Last 5 years.
No. So they are based on the revised figures, or they will get revised in April?
Yeah, every time, it's based on revised figure only, but every time it is previous 5 years.
Okay, so it's on a rolling basis? Yes,
a rolling basis.
Oh, okay. And sir, just one last question. On slide number 15, where you talk about the breakup of the resources, there is that commercial paper figure, and you've written something like embedded with NCD 3.4. Just wanted to understand what that is.
These are commercial paper which has party paid NCDs attached with it. So in case the commercial paper doesn't get rolled over, the full amount of NCDs get paid in. So this commercial papers are, that is why we are saying this is embedded, because there is an NCD which is for a longer tenure. So automatically the CP gets rolled over every quarter. And in case the investor wishes not to renew the CPs, they have to invest in the NCD for the longer tenure.
Okay. Okay, sir. Thank you very much.
Thank you. The next question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Thank you, sir. All my questions are answered.
Thank you very much. We'll move to the next question. The next question is from Prakash Sharma from CLSA. Please go ahead.
Good evening, sirs. My question is regarding the securitization income. I'm looking at page 5, the AUM breakup. Just wanted to confirm a couple of things. The off-book part, which is at about 2,100 crores right now, this is the book which is not the PTC type, right? This is a direct assignment, so it goes off the books.
Yeah,
correct?
Yeah, it is a direct assignment.
Right. So can I have the interest income related to this segment for the last 3 quarters, Q2 when it was very small and when post that it moved up? Could I have the interest? Because I understand that as per the Ind AS accounting, the income recognition on this happens upfront.
No. We have structured in such a way that the interest income is not booked upfront. It is deferred over the tenure of the agreement. It is similar to what we were doing in the SYL securitization.
Okay, so it is normalized and kind of done on a coupon sort of a basis. So
correct.
Normalized.
Yeah.
Sure. Thank you. And just in the rural markets, as you present, it will be more of an LCV market is clearly understood, but you're not doing tractors, etc. also there or what? Because I see from the mix, the share of tractors has gone down and, it's a popular product. So just wanted to confirm whether you're not doing it as much as you should.
No, tractors is a very attractive product for us. The yield is also quite good. Only thing is the ticket size being small, it doesn't get reflected. The average used tractor ticket size is around 2 lakh. So it immediately doesn't get reflected, but we feel that that is a very attractive product and we should be able to add more as we settle down in the rural market much more much more comfortably.
But last question, this working capital loan of about 60% growth, how, basically I assume this will be mostly to existing clients, but based on internal checks and balances, how are you trying to ensure that this is not taken to, service an existing loan?
See, basically it is product-based. And only when somebody is buying tire, we fund them. So amount goes directly to the tire dealer or manufacturer. Similarly, we have HPCL now tied up with the HPCL, wherein he fills the fuel and we make the payment directly to the HPCL. So most of this working capital loan goes directly to either the dealer, manufacturer, or the petrol pump, and to the insurance companies. All this general insurance renewal, we normally give as a finance package, 12 months repayment. So every 12 months it gets renewed. So nothing goes to customer directly.
The reason I was trying to check is, between 4Q FY18 to Q2, this book went up by about like 400 crores. And now it has, from Q2 to 4Q end, it has gone up by like 700, 800 crores in a tight liquidity environment.
No, we started aggressively on HPCL and all in the second half of the year only. In fact, our tie-up with HPCL was just 6 months old.
Okay, got it.
So many of this activity we started later.
Okay, perfect. Thank you, sir.
Thank you. The next question is from Jignesh Yal from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Most of the questions have been answered. Can I get the securitization done during the quarter?
3,600 crores.
3,600 crores, right? This is assignment as well as the securitization. Total is 3,600 crores.
800 is assignment and balance is securitization.
Okay. Thanks a lot, sir. Thanks a lot. All the best.
Thank you. Next question is from Nishant Chavade from Kotak Securities. Please go ahead.
I didn't quite, follow the reason for lower provisions in fourth quarter of FY18, just a 97 crore provision. So I was just trying to understand that math.
FY18, okay, Sundar.
In Q4 2018, we had a provision requirement of negative, it was a write-back in fact, of 295 crores, and the bad debt that we wrote off in the particular quarter was 384 crores, and this resulted in a lower provision write-off of 97 crores. In Q4 2018, we had revisited, added 1 year this one ECL provisioning norms, wherein the PD and LGD came lower compared to the December 2017 quarter. As I was telling you, every year in March we revisit this LGD and PD computation, and there was a benefit in the previous year, and there was a lower write-off in the particular quarter. These two factors resulted in a lower provisions and write-off.
Can you share the PD LGD numbers assumed in December and March?
Yeah. The LGD of December 2017 was 35.94. The PD was 5.95. 12-month PD, and lifetime PD was 16.57. And as against that, the LGD in March, when we revisited, it came down to 33.81%. PD was 5.81, and PD lifetime PD was 16.76.
Okay, and for the one that you assumed for this quarter, which is
current quarter, it is 32.46% LGD, 6.07 PD 12 months, and 17.24 lifetime PD.
So there has been actually a fair amount of improvement between last 4 quarters as well. I mean, I'm not doing the math up front, but all I'm trying to say is that there has been a fair amount of improvement in this period as well.
Yeah, there has been an provision write back in the current quarter also. If you see the provision requirement in Q4 was 267 crores. However, since we had written off our earlier equipment portfolio and other portfolios, wherein there were settlements happening, so there was a net write-off of 806 crores in the current quarter. So 806 and negative of 267 crores has made 539 crores as a provision write-off for the Q4 2019.
Okay, got it. Just one more number I wanted. How much was the securitization that you have done during the entire year?
Entire year was one second. It was
15,123 crores.
15,123 crores.
Okay, and of which assignment was?
Out of that, assignment was 2,800 roughly.
Great. Thank you very much and all the best.
Yeah.
Thank you. Next question is from Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hello, sir. Sir, to grow your AUM by 20% YY, you will need roughly 20,000 crores of additional liabilities next year. How you are going to fund this, especially when mutual funds are seeing redemption pressure and banks are not increasing their exposure to NBFCs. So, do you think 20,000 crores will be easy to get next year?
See, we have already raised $500 million 2 years bonds, and another 250 we can raise. We can also go to RBI asking for additional limit. That's one thing. Second, we have a retail program. We will definitely come out with our NCD issue every year. Last year we raised around 5,000 crores for the full year. So this year also we'll have a similar plan to raise the retail NCD issue. Then we are also deposit taking NBFC. We are also having a good inflow of deposit. Apart from that, the securitization is one route we look for raising resources. And last year we raised around 16,000 crores. And next financial year, this financial year also we can look at. So the sources for us are plenty. And we need to only plan according to the requirement.
But sir, if you are going for more retail NCDs and deposits, don't you think your cost of funds will inch up? Because these are two instruments where funding cost is higher than NCDs and bank borrowing.
Yeah. We have factored in that. We are only if we are able to pass it on to the customer, we would be able to raise it and lend it. So we are confident of passing on to the customer.
And second thing, sir, if you are guiding for 20% AUM growth, it leads to 30% disbursement growth YOY next year. Is that correct number? I mean, if I back calculate based on your repayment rate.
I think approximately it should be same.
Okay.
Yeah.
You are saying disbursement growth should be also around 20%, right?
Yeah, it should be around 25%.
And now, given that now your disbursements will pick up, right? And earlier you gave a reason that your disbursements are weak and that's why you saw NIM compression, right? But now if your disbursements are picking and let's say if you're saying that there would be 20% AUM growth, roughly half of your book would be originated next year, right? Where you would be able to pass on increased cost of funds to your borrowers, right? In that environment, don't you think your NIM should improve given the same logic?
Since we will be carrying a little higher cash, so NIM would remain at present level. Maybe there could be some improvement. But as of now, we would like to give a guidance of maintaining the NIM.
Okay. Thank you, sir.
Thank you. The next question is from the line of Abhijit Tibrewal from ICICI Securities. Please go ahead.
Yes, sir. Thanks for taking my question. Sir, of late we've been hearing that you're facing problems in raising money from banks. What process there to this statement?
The banks were slow, but of late, some of the public sector banks we have approached and the money is coming through. So it was slow. From October till January, it was difficult, but now it has slightly revived. So it's not that nothing is coming from banks. It has, as of now, started.
Okay. And at what rate are they giving you money now?
Which one?
At what rate are banks lending to you?
Okay. Banks lending is around 9.5 to 9.5, around 9.5.
Okay. And is there anything else that you would like to comment on the ongoing merger evaluation?
Nothing for now, because it is only a discussion point, and we are only looking at right synergy among all the entities. Once we have a clear thought process and synergy to present, then we will come out and discuss it openly.
Okay. And so do you have any timelines in mind?
No timelines in mind.
All right, sir. Thanks a lot.
Thank you. The next question is from the line of Parth Sangvi from MK Global. Please go ahead.
All my questions are answered. Thank you.
Thank you. We'll move to the next question. The next question is from Umang Shah from HSBC. Please go ahead.
Yeah, hi. Thanks for the opportunity. I wanted one data point. What is the outstanding cash and cash equivalent as on March 19?
8,000 crores.
Okay. And just regarding this PD LGD model, what is the time series of the data on based on which we calculate PD LGD?
5 years.
Okay. All right. Thank you and wish you all the best.
Thank you. The next question is from the line of Suchit Kavadkar from ICICI Lombard. Please go ahead.
So my question is regarding liquidity position. You said the total liquidity position is around 8,000 crores. Is it including unutilized bank lines or?
Excluding.
It is excluding. So
yes.
If I go to the balance sheet, I'm not able to connect.
In the investment book and the cash balance. Hello.
Yes.
Yeah, is that if you look at cash, banks and other above is 3,006, cash and cash equivalent is 2,900 and 3,000 crores roughly. And if you look at investment is 4,000 crores.
Okay. And how we see ALM position for next 6 months to 1 year? Is it comfortable or?
ALM is comfortable. One is the bonds, what we have raised overseas is long duration. Securitization is what we largely did, and this is also matching the entire duration of assets. ALM currently is positive in all buckets, and I don't foresee any change there. It should further improve, in fact.
Okay. So because if I see around monthly, our outflows are higher than 6,000 crore, so that's why I asked how we see it going forward. It's comfortable according to you.
Which outflow? We don't get you.
Interest and principal repayment outflow, if I see monthly for the company.
I don't know where you are getting it from, but this specific question can be answered by Sanjay later, because we are not able to understand this.
Okay. Yeah, I'll get back offline.
Thank you. The next question is from Darpin Shah from HDFC Securities. Please go ahead.
Yes, sir. Thanks for the opportunity. Our disbursements have grown significantly on a QoQ basis, but the AUMs are still flat. So what explains this?
Look, the collections were quite strong, and that could be the reason. And that's all.
So any change in strategy or something where collections went up significantly in this quarter?
Nothing in that. The focus and drive was there on collection, so no change in strategy as such.
Okay, fair enough. And second thing is, in the borrowing mix which you have mentioned, where some CPs are embedded with NCDs. So there, do we pay additional any cost, or how will be the pricing difference?
No, we don't pay any additional cost. We don't pay any additional cost.
So for these CPs and the normal regular CPs will be priced same?
Yeah, they will be priced same.
Okay. Hello?
They will be priced same.
Okay, yeah. Thanks a lot.
Thank you. Next, we have a follow-up question from the line of Pratik Cheda from IIFL. Please go ahead.
Hello.
Hello, yeah.
Yeah, sir. Thanks, but my questions have been answered. Thanks a lot.
Thank you.
Thank you. The next question is from Praveen Agarwal, who's an individual investor. Please go ahead.
Yeah, thank you for the opportunity. Sir, I want to understand a couple of questions. One, does our loan book still qualify for priority sector for banks? That's one. Two, is what was the hedging cost of the dollar bond which you did? What level did you do the bond, and what is the hedging cost of converting it into INR?
Okay, when it comes to the bonds hedging, the coupon what we did was around 5.7, and it depends upon when you are doing and with which bank you are doing. There will be credit cost involved. It keeps varying. There will be 10 to 20 basis point difference between various banks and the time when we are doing it. As of now, if we look at the weighted average cost of the entire bond issue, the total cost came to us at around 10.25%. So depends upon, though I'm not saying that is the single cost across all banks, it depends upon wherever we have different lines. 10 quarter is the overall cost to us.
Okay. Thank you, sir. So, and also if you can share some light on the priority sector, does our loans qualify for priority sector for banks?
Yeah, since we lend to small truck operators, everything qualifies for priority sector.
So, sir, if you can share then again some light on how the priority sector lending certificate market has developed. Do we participate in that where we don't transfer the assets but we can just kind of
Yeah. NBFCs are not eligible for participating in priority sector lending certificate between the banks.
Okay. Thank you, sir.
Thank you. We have one last question in queue. The last question is from the line of Harsh Agarwal from Infina Finance. Please go ahead. Harsh Agarwal from Infina Finance. You may go ahead with the question.
Hi. Can you hear me?
Yes, please.
Yeah, sure. Thanks. So the query is regarding the derivative financial instruments line item on our balance sheet. For the second quarter and third quarter, we had around 3,000 crores of derivatives on our balance sheet, and this quarter the number has drastically reduced. If you can help me, what has happened on that line item?
It was primarily related to the hedging that we had done earlier.
So hedging, we did it on our foreign currency borrowings?
Yeah, foreign currency borrowing.
So, but sir, during the quarter we also raised further foreign currency borrowing. So, shouldn't this line item would have gone up?
I don't have the number offhand. Okay, offline maybe Sanjay will be in touch with you on this.
Okay, sure, sir.
Yeah.
Sure, thank you.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
Thank you for joining. We do see a strong next financial year as far as the credit demand is concerned. The post-election scenario where the new government will push the overall infrastructure is what we believe strongly. And second, the monsoon prediction being good, BS4 to BS6, these are three big things I think will create a better demand both in urban and rural. So we are very confident that our growth rate, net interest margins, collection and overall credit quality will improve. And okay, thank you for joining the call. That's all.
Thank you very much.